Whenever I make a video talking about how I think BRICS is garbage or China's not going to overtake the US or Russia's economy is failing, I get a lot of comments from those who love Russia, love China, think BRICS is going to be the end all be all, and they tell me how I'm full of crap, and it just encourages me to make more videos. So this is one of those videos where I talk about the conditions of the Chinese economy going forward into the future. And the reality is the conditions in the Chinese economy are far worse than I think anyone actually really thinks. We all assumed that the Chinese economy was going to recover and we'd see moderate growth, probably growth that would come on par with the United States, but never really to pass the United States in general. Originally, the thought was a decade ago, the Chinese economy was going to rocket past the US. That view has changed significantly. Now, according to Desmond Shum, who was the head of a multi-billion-dollar development investment firm in Beijing, talks about how sales across industries, those where he has a lot of contacts in, and even those industries thought to be insulated from any slowdown, are falling. And the economic outlook among Chinese consumers is so dire that executives are reporting blatant acts of theft by employees. And it's not just like staplers and paperwork you're talking here. We're talking about people are stealing furniture, stealing food from vending machines, just basic necessities to live in China. Several things shook Shum when he talked to some of his friends in China. He said that a big dairy company is producing more milk powder because people are cutting back on buying milk. That's normally something that you would see cut out last, not something you'd see cut out this early in any kind of downturn, which means that we may be underestimating the level of the downturn in China. A lot of the times because China loves to fudge their numbers upward, not entirely on the fault of the CCP, because the CCP puts quotas on its local governments to meet certain targets, and therefore the local governments need to meet those targets or else they are fired from their positions, so they tend to fudge their numbers at the lower levels, which feeds inaccurate information to the CCP. China is providing an inside look into a stagnating growth for a major economy. And the country's post-pandemic recovery has slowed way faster than we expected. In fact, it slowed down in the first quarter, and we thought that they would be doing well for the entirety of 2023. Recent data shows that Chinese producer price indexes dropped by the fastest rate in 7 years last month, while consumer prices now linger at the edge of deflation for the first time since 2021. And back then it was due to COVID. So this deflationary period will be driven by bad policy, not a pandemic. And I know what some people think, well, deflation could be a good thing. For the average consumer, it can be, but for a broader economy such as China's, it's very bad. It means less production, which means companies will start laying off employees, which means more employment, which means a vicious cycle of a further weakening economy. And a weakening economy has also become evident in the growing joblessness among the country's youth, where over 20% of 16 to 24-year-olds were unemployed in May. Meanwhile, debt burdens continue to weigh on the property market, further straining new economic growth. And Beijing is reacting to this. The People's Bank of China has implemented interest rate cuts to try to get people to start spending money again. But this is a double-edged sword, because as they may spend more money internally, externally people go, I'm not going to invest in China, they're cutting their rates. I'm going to go invest in the United States, where interest rates are on the rise due to the recent red-hot US economy. So a lot of investment in China is being redirected to the United States, and it's causing a manufacturing boom in the US. And in Shum's view, conditions are also making the country's top officials really insecure. They're trying to control businesses, especially foreign firms, by forcing them to turn over intellectual property, limiting their data access, and also just flat out conducting raids. And this is contributing to a significant withdrawal of international firms from China, as they decide that there are probably more favorable business practices in places like Vietnam, Indonesia, Sri Lanka, India, and even South America. As I've said, the US is likely looking to pivot to South America for a lot of its manufacturing needs. The issue is, people talk about deglobalization, but the proper term is a re-globalization minus China, according to Shum. Some important metrics to talk about here that are evidence in what is likely going to become an economic contraction. The Chinese exports dropped by 9.9% from last year. The Chinese property sector bust has led to a significant contraction in land sales, which are highly correlated to local government revenues, which are on average make up about 40% of their local government revenues. Since the property market isn't likely ever to return to the prosperous days of the 2010s or the 2000s, local governments simply can't depend on revenue like they used to. In fact, the land sales in China have dropped by 22% in the first quarter of 2023 alone. Over 70% of China's individual investment wealth is in property and real estate. It was the real estate investment that secured a family's place in the middle class. In fact, it was such a highly sought after thing that people would just buy property without even seeing it. You had to own property to be a desirable mate for the opposite sex. It is a significant venture to buy property in China, and now it's crashing. The problem isn't just for older people nearing retirement years either. The property bust is hurting prospects for the next generation as well. With no land sales to rebound in sight, debt obligations mounting among local governments, they need to find savings somewhere. So entitlement and welfare spending, which on average accounted for about 20% of local expenditures, appears to be where these local governments are looking to cut. Some starved local governments are raising college tuition fees by 54% at a time when youth unemployment is over 20% and a record number of students are trying to get higher education. Even the Chinese Communist Party seems to have encouraged localities to execute entitlement cuts. For instance, the central government capped the increase on pension benefits at 3.8%, which is almost double the amount lower than before. They cut it in half from what it was before. Moreover, Beijing has instructed local governments to aggressively cut healthcare benefits, which has triggered actually some pretty large-scale protests in multiple cities. And this is a bad time to be cutting entitlements when Beijing should be accommodating the hundreds of millions of expected retirees over the next decade. Chinese retirees, those over 65 years old, are expected to almost double from 195 million people to roughly 360 million people in the next 18 years. It's as if the United States all became retirees at once. China wants to become more self-sustaining and a far more stable consumption-based GDP rather than relying on exports to nations that could potentially see China as belligerent. And also an export-driven economy gets hurt by events outside of its control, say a pandemic or a war. 1/5 of China's economy is based on exports versus 1/10 of the US economy. Consumer consumption only makes up 37% of China's economy, while in the US that figures about 70%. But less entitlement spending means older Chinese people will start to save money for the future rather than spending, leading to further drags on the Chinese economy and further reliance on exports rather than internal domestic consumption. Couple this with the population drop, and consumption driving their GDP is just not going to carry the Chinese economy, period. China has the fastest growing debt burden in history, as many of their international Belt and Road Initiative investments and real estate ventures are costing China more than their economic benefit gives them. The problem is China was investing as much as 47% of its GDP into these costly projects, and the US only really invests 20 to 25% in far less risky endeavors. As a result, China's debt to GDP is an extraordinary 290%. Meanwhile, the US sits at about 129%. Despite China setting an ambitious recovery growth target of 5%, which the IMF has already cut to 4.4% back in April, it looks like it's going to be even slower. According to UBS, sequential growth may slow to only 1.2% quarter on quarter seasonally adjusted, which is far weaker than what UBS expected of the expectations of 4.5%. Regardless, they likely won't break an average of 2.5% growth per year over the next decade and will experience severe negative growth starting in 2035, meaning they will never surpass the US. The only way back to break this cycle is a surge in the rate of consumption growth as it replaces investment growth as a driver of GDP. Given that this has never happened in any country ever, and China's population is aging out while saving more due to pension cuts, it won't work in China. A communist country must maintain social welfare spending to function. China is on the path of the Soviet Union by reducing social programs, increasing costs on things that were free services, and reducing pensions, all while increasing military spending. We will see a major recession in China in the next 10 years and possibly a full economic collapse by 2040. We may be looking at the Soviet Union 2.0 at this point.